Welcome back to Pro News Weekly. This week, the markets are giving us a real sense of déjà vu.
They really are. The US dollar has taken a trip down memory lane, the stock indices are climbing, gold has lost its shine, and Bitcoin is changing direction.
Lots to unpack. Let's start with the dollar.
So, the dollar reacted to the end of the Middle East ceasefire, exactly the way it did before the US-Iran deal. First it rose, and then it started to give ground. Those swings were really the market working through inflation and Fed policy. When Brent soared to $120 a barrel, investors were on edge about the prospect of interest rate increases. But the peak seems to have passed, and that's calmed things down. Consumer and producer prices both slowed noticeably in June, and investors doubt Brent can reclaim its March highs. So they're stepping back from bets on aggressive Fed tightening, which is weakening the dollar.
On to equities. The S&P 500 has risen in 5 of the last 6 sessions, with investors shrugging off the geopolitical worries. They're focusing on the lower odds of Fed rate increases as inflation slows and looking ahead to upbeat second quarter earnings. Banks reported first, and the 6 largest lenders posted a 39% rise in profits.
Though it wasn't all good news in tech, was it?
Not at all. International Business Machines had its biggest ever share price fall amid reports that it had failed to adapt to changing market conditions. That's casting a shadow over the whole information technology sector and reinforcing the rotation into alternatives.
Let's move on to gold, which is still under pressure. Some fear that increasing oil prices will force central banks to sell gold reserves to prop up their currencies. That's chipping away at gold's status as a safe haven asset. It isn't finding support, even as the conflict in the Middle East escalates.
And there's a broader policy story running underneath all of this. Markets are pricing in widespread monetary tightening. The European Central Bank and the Bank of England are both expected to increase rates twice in 2026, with the first move forecast for September. And the probability of the Fed tightening in 2026 is put at 73%. Over to Bitcoin, which is very much taking its cue from rate expectations. When the odds of a July Fed rate hike climbed to 40% amid the escalation in the Middle East, Bitcoin fell. But it's since recovered as the chances of tightening at the next FOMC meeting dropped to 10%.
And the fund flows are turning more supportive too.
They are. Bitcoin got a lift from a $197 million inflow into exchange-traded funds over the 5 days to the 10th of July. That comes after an 8-week outflow that included a record $4.5 billion in June. So it's a meaningful shift. So what are the main events to watch?
Investors will keep watching the Middle East and what it means for monetary policy. And the big one is the European Central Bank meeting in the week leading up to the 24th of July. The bank isn't expected to increase rates, but markets will be listening closely for any signals about whether the tightening cycle continues.
Anything else on the calendar?
A busy one for the UK with labor market, inflation, and retail sales data, all of which could mean more volatility for the pound. And business activity figures will show how economies are coping with the rising geopolitical risks.
That's it for this episode. Stay on top of global market moves with Pro News Weekly.
Like, share, and subscribe, and we'll see you next week.